Hello, and welcome to Portfolio Matters Weekly Update, Week 46. Before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith, on to our charts.
Thank you, Richard. First of all, a reminder, we will be in the pub again on Wednesday, the 1st December, at the Princess Louise in High Holborn, London, from 6:30 onwards, and it would be great if you would join us.
Yes, indeed.
Okay, this week's news. Well, there wasn't that much economic news, but Austria and the Netherlands have announced new lockdowns as there was a resurgence in COVID cases in continental Europe. Now, the lockdowns are not as draconian as earlier in the year or last year, but the case load is getting worse, and we will show you some charts later. Now, Germany temporarily suspended the certification of the Nord Stream 2 gas pipeline from Russia, and we will show you a chart of natural gas prices in Europe, and they shot up this week by over 20%. And it looks like Europe will suffer a gas shortage this winter, and with unpredictable but invariably negative effects.
The reason they suspended the certification is because the ownership structure of the subsidiary that's supposed to be operating in Germany doesn't meet the regulations.
Thank you, Richard. Most of the rest of the world is unwinding stimulus and actually looking to reduce QE and actually start raising interest rates, or at least they're threatening to. Japan continues to go down the stimulus route and has announced a new 350 billion fiscal stimulus program. That is in addition to the 770 billion they've already spent since the start of COVID, which is the equivalent of 17% of GDP. And that will involve them sending checks of $872 to families with children under 18. And a reminder, Japanese government debt is currently at 266% of GDP.
Extraordinary.
Okay, so on to some economic data. And it was quite a light week, but we had UK inflation numbers, and they once again came in hot. UK CPI inflation came in at 4.2%, big jump on September, which was 3.1%, and well above expectations. Core CPI again beat expectations and came in at 3.4%. RPI came in at 6%. Now, a reminder, RPI is the way we used to calculate inflation and use the arithmetic mean. The CPI, which we now use, uses the geometric mean. And the theory behind switching to the geometric mean was it accounts for the fact that consumers will switch to a cheaper good. So if the price of carrots goes up by 20% and the price of broccoli only goes up by 10, essentially the statisticians will assume that consumers are going to switch to broccoli, and hence their consumption basket will not go up by 20%. It will go up by a mix somewhere between the 10% of broccoli and the 20% of carrots. However, if you look at a measure of your preferred consumption basket in the case of carrots, and then RPI is a better measure because it shows the inflation you would incur if you were to stick to your preferred consumption basket.
It's frankly, it's smoke and mirrors, isn't it? Because basically it's a way of avoiding recognizing the fact that a particular basket is inflating.
Yeah,
it's nonsense. It's like saying, well, we know steak has tripled, but actually offal still is cheaper, so we're going to say there's zero inflation on meat. It's a nonsense. It's a clever intellectual trick.
Well, it suits people, Richard.
It does.
It suits the governments of the world, because amongst other things, they have lots of inflation-linked liabilities, and if they can manipulate down the inflation statistic, that suits absolutely everyone.
Yeah.
Now, UK retail sales in the UK came in okay, up 0.8% on the month, which is better than September and slightly ahead of expectations. Retail sales year on year fell, though, down 1.3% year on year, and that was worse than in September, but better than expectations. Now, public sector borrowing, those numbers came out today, and they ain't good. The public sector borrowing was worse than consensus expectation and was still a massive number. It was £18.8 billion for October. We'll show you a chart later. Now, in Europe, we had construction output for September, and that came in at a reassuring 1.5%. Reminder, in August, construction activity had actually fallen. Now, new car registrations. Well, the computer chip shortage continues to bite. And in October, new car registrations were down 30% year on year, and that was worse than expectation and worse than September. In the US, we had new housing starts, and they were pretty much the same as October, slightly below consensus expectations. Now, we have got to the bottom of this number. So regular viewers will know that we'd previously been puzzled by how you could have 1.52 million new housing starts in October. Well, it's an annualized number. Okay, and then we had a load of survey data from the Philadelphia Fed, and all this data reflects the manufacturing sector alone. So the index rose strongly to 39 from 23.8 in October. So that's good. So manufacturing sector is doing well. The prices paid continues to rise. Business conditions were improving. The employment index actually fell back slightly, which is a puzzle, but new orders looked really good, 47.4, and we'll show you a chart of that later. In China, house price inflation in October slowed to 3.4, if you believe them. We'll show you a chart later. And we also had data on EU GDP growth, which in Q3 was 2.2% quarter on quarter, which was very respectable, up slightly from Q2. And year on year, you have some comparative problems, but came in at 3.7%. Okay, some charts. Richard.
Thank you, Keith. So here's China house price inflation year on year, which is actually been following a bit of a downtrend for the last two years. And as Keith sort of suggests, we're not entirely sure how reliable the data is. And the annualized US new housing starts, 1.5 million, looking very healthy. And as Keith says, now we understand what the figure means. We can put it into appropriate context. US Philadelphia Manufacturing Index is actually, if you ignore the COVID dip, it's actually in a bit of an uptrend for the last 2 years. US new jobless claims at a very satisfactory low point, indicating strength in the economy, and continuing jobless claims also looking very healthy and indicating strength in the employment market in the US. And the prices paid index is still appears to be firmly in its uptrend. We know there's a lot of costs coming through that will probably result in that uptrend continuing for the time being. Commodity prices, materials prices. And it's at the highest level that it has been at since 1980. Manufacturing Business Conditions Index is just ticking up a little bit. So this index has been in a range since 2010, and it's at the bottom end of that range, but it doesn't appear to be falling either out of it or leaping up at a terrific rate, which suggests a fairly stable environment, I would guess.
Well, it's reassuring it's bounced back a bit. I mean, the supply chain difficulties and input prices are a big headwind, I would have thought.
And the Manufacturing Employment Index partly explains why there's a shortage of workers, because the index is going up quite rapidly, really, and it's the highest level since I presume records began. US Philly Fed manufacturing new orders is at the highest level since records began, has shot up in the last few months.
Yeah.
Which of course is indicative of why the labour shortage, why there's an increasing labour shortage in the US market, and why employment figures are so good. UK public sector borrowing, I mean, it just doesn't look good, does it? It seems like it's shifted down a level from, it was fairly static with that sawtooth pattern for 8 years, and it looks to me as if that sawtooth pattern has just shifted down by 5 billion a month or so.
Yeah, no, it's
10 billion a month.
Yeah, 10 billion a month. Okay, on to Inflation Watch. And we had some updated figures and some new figures. So the main new figures were for the UK, where CPI came in at 4.2%, as we've discussed. RPA came in at 6%. We also had confirmed figures in the EU at 4.1%. Japan, also we had October figures, which were pretty much unchanged. And really low. So hence they're doing more fiscal stimulus, because if it didn't work the first time, you just try harder.
So what's interesting about this, Keith, is just if you look at the EU, 80 billion a month roughly of QE, negative interest rates, you've got to ask the question, well, why? Because the EU economy, on the basis of the stats we've been looking at, isn't doing particularly badly. And the answer is because if the ECB doesn't continue to have this incredibly accommodative regime, the peripheral government debt will take a complete bath, and that will lead to the second Eurozone crisis.
Well, I think that's an absolutely excellent point, Richard, because when you look at the economy is doing absolutely fine. So the only reason you're keeping interest rates so low and pumping in QE is because of stresses in the financial system.
Yeah. And of course, if the Southern European, highly indebted Southern European nations do hit an economic crisis, financial crisis, then the target too comes back on the table, which is over €1 trillion, which is the amount of money they owe to Germany, which puts Germany in the frame.
Yep.
German banks and the German banking system in the frame.
Well, the thing is, if they need to keep interest rates low indefinitely in order to preserve the finances of the Eurozone, well, that's going to have serious knock-on effects elsewhere in the economy, which will overheat, and we'll show you some graphs later. So this is inflation expectations, and they are rising, including in the Eurozone. Now, in the Eurozone, remember, they have a 2% target, which they're failing to meet, but, you know, it's on course for rapidly exceeding that. In the US, it's a well exceeding a 2% target.
Yeah.
Now, we know that a lot of the inflation pressures we're seeing are due to supply chain difficulties. Now, this is freight rates internally in the US, and it has hit 36%.
Wow.
And supply chain problems in the US don't appear to be getting any better, frankly. That is a very ugly looking chart. It appears to be getting worse just in time for Christmas. Although international shipping rates appear to be falling, which is good news. We actually showed this chart last week, and this is from Bridgewater Associates. But if you look bottom left, they make a very good point about the nature of the current inflation. If you look in the 70s, then inflation was caused in large part by supply disruptions. So the red line is production of goods for US consumers, and you see all the strikes, etc., caused a big dip in production. Whereas now, there's no dip in production. It's all caused by giving consumers a load of money during COVID, and then, funnily enough, they're spending it. So demand has gone through the roof. And the same is true for services. The blue line is demand. The red line is services employment. And we know, having shown you a chart earlier, the participation rate is low and is not improving. And it doesn't look like demand pressures are going away anytime soon. So these are US retail sales, and they're growing at what, 15, 16% per annum. So top left, US firms are finding it incredibly difficult to fill positions. The job openings now outnumber people looking for work, i.e. the unemployed, and American workers are quitting jobs at a record rate because they can get better wages from quitting. So the blue line is the wage growth rate for people who've quit their jobs. The white line is people who've stayed. And it pays to switch jobs. In the UK, labour shortage is the worst they've been since the 1970s. But of course, don't worry, there won't be a wage price spiral because the central banks say there won't be. And a lot of people have left the workforce. So the red line is the number of people who are searching for a job, and as they find a job, that line is declining. And the blue line is people who have left the labour force. And that's actually rising. So job vacancies are going through the roof. Companies can't find labour. Although wage growth did dip down slightly in the US last month. Last month.
Yeah. I think with all of these graphs, they never move in a precisely straight line, do they? In fact, if you look at the Atlanta Fed, the blue line, that dipped down, presumably a month up prior to that, but then continued its upwards trend.
Good news is that wage growth is actually much higher for people in poorly paid jobs than it is for people in highly paid jobs. Which is good for inequality. And women's wages are rising faster than men's. And combining all those trends together, you can see that quit rates are highest in the low-paid sectors, so combination of food, services, retail, and then in the highly paid sectors, they're low. So lowly paid workers can get, there's demand, they can get a better deal by quitting and finding something else. Now, one thing we've covered in successive weeklies is that rents are rising, and they're 32.5% of the US CPI basket, and the CPI rent index has not risen that much yet, but will be doing so over the next few months, which will keep US inflation high.
And it has actually taken off like a rocket, hasn't it? There's no gradual increase in the trend. It's just gone bang.
Yep. But don't worry, Goldman Sachs are forecasting that it will be transient.
So, Keith, I don't understand this because Jeff Curry, the Goldman Sachs head of commodities, is saying that we're just at the very beginning of a commodities super cycle, which suggests that commodity prices will continue to rise for the next 10 years or so. So how on earth can they then come out and say the inflation is going to be transient? with that sort of a background?
Well, commodities consumption is a small part of the basket, Richard, but my big pushback on this is that it seems to assume that the economy is static. And, we know that workers' wages are not keeping up with inflation and that there's a shortage of workers. You have all the elements in place for a wage price spiral because workers will just move to a job that pays them more than inflation.
What concerns me is also, this actually, this is the Fed line, and it's like it's come out and it's endorsing the Fed's line. And it says, falls to the low twos as a transitory inflation boost from durable goods becomes a transitory deflationary drag. But we're seeing rent increases, commodity price increases, energy price increases, wage increases. I mean, it simply seems to be flying in the face of the evidence. And since the Goldman Sachs is a very clever group of people with a great deal of understanding of what's going on in the economy, I just wonder why they've produced this. The
other thing is the inflation numbers continually surprise on the upside. And we've just seen that in the UK. Again, 0.5% higher than expectation. And talking about inflation, so these are the electricity prices in Europe yesterday. And obviously energy is a core ingredient in pretty much everything, but particularly in manufactured goods.
Keith, I'm going to ask you a question here, which I don't know the answer to, which is France is 80% of France's electricity is generated by nuclear power. So why is French electricity so expensive, or French?
Well, the trouble is, Richard, everything's set at the margin, isn't it? So
yes, I guess they sell it abroad, don't they? So yeah.
But also, they have to buy in that last megawatt hour, and that's if the wind's not blowing, they're having to buy it in from whoever's got spare capacity, or they're having to pay up for natural gas.
Yeah, no, you're quite right, Keith. That is the explanation.
Now, this is a chart from a few weeks ago, and since then, the chart has come down. So the price of German 1 year ahead power has come down. But the reason I'm showing you this again is just to emphasize the fact that prior to this year, the German electricity price was below 40 euros. And now if we go to yesterday, you're seeing in France, it's 240 euros a megawatt hour, Germany 131. These are big numbers, big changes. And another vertical chart, this one for fertilizer prices, which will feed through to food prices. And if we update our data from the UN Food and Agricultural Organization, you'll see their food price index continues to rise, led by vegetable oils, cereals.
Just a reminder on fertilizer, a lot of it is manufactured from natural gas.
Yeah.
And that's the reason fertilizer prices have gone up so fast, so far.
Yeah. So as a result, real food prices are higher than in 2011, when you remember the Arab Spring was in large part caused by a spike in food prices, where in countries where people are spending 30% plus of their income on food. And I thought this was amusing. Take me somewhere expensive, the supermarket.
So the Hindenburg Omen is a technical indicator designed to forecast stock market crashes. So under normal circumstances, stocks should in general be trending higher or lower together. So stocks should all be hitting new highs or new lows. But if many stock market constituents are hitting new highs, while a similar number are hitting new lows, then something strange is going on. There's a divergence in the behavior of the market. So the Hindenburg Omen occurs when 2.8% of the New York Stock Exchange index constituents are hitting new highs, and 2.8% are, or more, presumably, are hitting new lows on the same day. So we have a chart of where the Hindenburg Omens have occurred. So you can see that they predicted the continuation, well, the beginning of the fall, and certainly the continuation of the fall in 2000. they undoubtedly predicted the crash of 2008, and they were probably a year ahead of that. And their record subsequently hasn't been so obvious. So in 2015, you could say they predicted it, but the drop wasn't particularly large. And for 2020, they didn't predict. Well, there's this huge sort of, I guess the problem with them has become that the market has become much more volatile in terms of the performance of the constituents in the last 4 years or so. So there's a high level, background level of Hindenburg Omens all the time, which you don't see in earlier years, which means presumably means its predictive capacity is less strong because you've got this background of the omens. But what you can just see on the right-hand side is it is spiking up now. But whether it gets to 15 or 20, where it really seems to be at its peak historically, remains to be seen. What do you think, Keith?
Well, I think that this is actually all right. I mean, I think the question is, how much is it a predictor and how much is it essentially a contemporaneous measure? Yeah. But
2008, it definitely predicted.
Yeah. And it's picking up now. I mean, I think it's something to pay attention to, particularly if it heads towards 20.
But it's not forecasting an imminent correction now, is it?
Not really, but it's picking up.
Yeah.
So, and I also think we're just in peak seasonalities period.
We're in peak everything at the moment, aren't we? Yeah. There's a bubble in Hindenburg Omens, frankly.
Yes, well put. Okay, moving back to supply chain disruptions. So the number of ships just waiting outside US ports, it ain't coming down, despite the falling international freight rate. And actually, you can look at the falling international freight rate as a symptom of the fact that, the boats just can't get into port. So why hire them in the first place?
Yeah.
And it's just wasting a lot of time. Container ships now waiting an average of 17 days to enter the port of Los Angeles. And those are expensive, just sitting around outside port. That's a lot of money. The problem appears to be actually the US ports are processing fewer ships. And we know that there's loads of freight going around the world. So you have essentially higher demand for port services and lower capacity. So, of course, you're getting delays. And back to Richard's point about the container ships going away, well, they should be going away with, full containers, but obviously the US runs an enormous current account deficit, so it imports far more than it exports. And so it should be sending back empty containers. But there's a lack of financial incentives to organize the return of the empty containers, and they're just building up in the port, blocking up everything.
So is that a harbinger of, is there some reduced demand in the system now that we haven't actually seen any other way?
There's a story in the FT today, which if you're interested, I suggest people read. And there appears to be some administrative difficulties in just organizing the return of these. And also there's just lack of finance. It's more profitable to ship in and ship out full containers than it is to ship out empty ones. So they've just they're stacking them up.
Makes you wonder if there's a lack of demand in the Far East for empty containers to fill with goods.
I think your point earlier, Richard, about how, given the cost of freight, it might be simpler just to build a new one than have one of these an empty one shipped back halfway around the world.
Yeah. Yes.
Okay, moving on to China.
So this is property price bubbles compared China 2000. So they are aligned at the point in time at which the property index was 100. So, for example, the Japanese property bubble occurred in year 2008. And for the last 30 odd years, the property market has either been in decline or flat. So the Chinese bubble has been expanding for 18, 20 years and is enormous in comparison to the Japanese property market bubble, which we knew caused huge problems for Japan, and to the US property market bubble in 2008. And it surely indicates that China does have a serious property bubble problem. And I think we talked about this a little bit last week. So a lot of property developers have take money through pre-sales, and the local authorities in China have recently, over the last few weeks, said to property developers that pre-sale revenues have to be used to finish existing developments and can't be used for repaying debt, which obviously creates a big cash flow problem for Chinese developers because they have a lot of debt that needs to be serviced. So this graph shows that asset valuations aren't the primary problem. So the graph shows the property price index in black from 1997, the per capita urban disposable income in brown, which is following a sort of a gentle, slightly exponential curve upwards, and the ratio of property prices to disposable income, which has dropped from 1 to 0.65, although probably for the last 10 years hasn't really changed very much. So the affordability of property did drop significantly from 1997 to around about 2010. And from then, it hasn't really changed very much in the last decade. And property construction is well above fundamental demand. Fundamental demand is the average occupied housing area per resident. So you can see that really for the last 15 years, Chinese urban construction has been for investment. It hasn't been for living in.
As a result, residential property accounts for 66% of households' total assets. Essentially, the Chinese have suppressed interest rates, so nobody wants to put money in the bank, and they put their money in residential property instead.
So the junk bond yields are falling. We know that the Chinese government took various measures to ease the pressure on house builders and repayment of debts. They eased the regulations that they implemented in order not to crash the market. And those steps appear to have had some amelioratory effect, although the absolute level of interest on these junk bonds is still very high. And construction activity in the thick line has fallen off a cliff. In fact, it's fallen down to where it fell when the country locked down.
Yeah.
And this is a graph. The other line is the industrial metals prices, which actually follows Chinese construction activity quite closely, because China construction is such a large consumer of industrial metals, which doesn't bode well for industrial metals such as iron and other commodity metals.
Yeah, including copper and all the other ones we like.
Yes.
So something to be aware of.
Yeah, I think so. Cautionary note there. And construction activity index is just looking dreadful. And the floor space sold and started is looking equally dreadful. I mean, the Chinese property market is undergoing a serious contraction. And China retail sales have slumped this year. They just picked up to trend after the COVID lockdown, and now they're dropping away.
Well, I find this chart really interesting because we know in the West, the Western governments have pumped loads of money into the economy and given through direct checks to households. And you've seen a huge surge in consumption. And in China, that hasn't happened. In fact, retail sales are well below trend.
Chinese GDP growth in quarter two was apparently 4.9%.
Moving on to emerging markets. Now, John Authers at Bloomberg had a series of charts on emerging markets showing just how much they have underperformed the rest of the world. Now, bear in mind that emerging markets, I mean, 10 years ago, the thesis was that they were growing much faster than the stagnant old economies. But I'm afraid that both the currencies and the equity markets have serially underperformed over the last decade. You look at the BRICS, where you remember that BRICS stood for Brazil, Russia, India, China. Essentially, their equity markets have gone nowhere and are slightly down since the great financial crisis. In contrast, the S&P 500 has pretty much doubled. And if we look back at the boom years before the great financial crisis, the blue line is emerging markets index divided by the world index. And you see that essentially were a geared play. So they doubled relative to the world index over that period. Obviously, since then, they've given a lot of that back up. What is really interesting this year is that normally you expect to see a link between the relative performance of emerging markets and the performance of industrial commodities, in this case, metals, because they're all mainly commodity exporters. And you'll see historically there's been a decent enough correlation. But this year, correlation's completely broken down. Industrial metals have strongly outperformed. Emerging markets have underperformed. Now, how much of this is just the value trade and the fact that investors are paying up for growth and continue to neglect value? But
I think it's basic materials is certainly not a very sexy sector to be investing in at the moment, is it? I mean, Tesla is far more enticing, surely.
Yeah, for some.
Yes.
Okay, moving on to other charts. And I thought this was a really interesting chart. It claims to have calculated corporate profit margins going back to 1870. And it shows that actually corporate profit margins are the highest they've been since the 1920s. So much for competition and, breaking down barriers and improved market efficiency.
It's the S&P, isn't it? And of course, we know they have a real problem with monopoly and oligopolistic behavior at the moment.
Yeah, no, I think it is, actually. I think it's tech companies with quasi-monopolies.
Yeah.
And if you look at household wealth as a percentage of GDP, it is now back to its levels of the boom years of the 1920s. And we all know what happened next. It mean reverted quite strongly. So just saying.
Yeah, watch this space. We'll keep an eye open.
Now, we've heard quite a lot over the course of COP26 about hydrogen and various companies announcing initiatives to invest in the hydrogen economy. Well, I really wonder about that because hydrogen is just incredibly inefficient. If you generate hydrogen from electrolysis using electricity from a wind farm, then you lose 30% in the electrolysis process to generate the hydrogen gas. You then have to compress the hydrogen, move it around. It's a physical commodity, that requires quite a lot of energy. And then when you burn it in the fuel cell, you only get about 50% conversion. You then have to convert it from direct current to AC, that loses you a further 5%. And then you lose another 10% in converting the electricity into motion. In total, you get back about 22%. That compares with a battery. I just can't see hydrogen taking off.
You can see hydrogen as a substitute for natural gas in the natural gas network for home heating. But why not just transmit, when you get to that point and your grid can take it, why not just transmit the electricity direct to the home and then use electric heaters? I agree with you, Keith.
And recently, you may have seen that US consumer sentiment has taken a real dive. And actually, inflation is a big part of that. So the yellow line is the US Consumer Sentiment Index, and the blue line is CPI year-on-year change. And you'll see whenever the blue line spikes, consumer sentiment takes a bath. Now, I thought this was interesting. This shows the performance of ETFs before and after listing. So what it shows is prior to their launch, the trends followed by the proposed ETF do very well and tend to outperform the market. And then the moment the ETF goes live, it does nothing. You've got to love the finance industry.
They're a good contraindicator, Keith. If you've been in a market that's subsector that's been showing a good positive trend and a lot of ETFs come in, it's time to sell.
Yeah. Now, good news. The Atlanta Fed GDP Now forecast for Q4 is really strong. They're forecasting US GDP growth of 8% plus. Now, we know that actually the GDP Now turns out to be not a terribly good forecaster, but that is good news if taken at face value.
Mm-hmm. Yep.
And the economic surprise index has turned back up in the last few weeks, and that is good.
Mm. Of course, we're going to be getting another $1 trillion or something, aren't we, of US government largesse coming into the US economy over the next year or however long it is.
Yeah. And I love the fact that Kamala Harris, when talking about the infrastructure bill and the extra, what it was, 1.75 trillion, was saying how it was designed to be anti-inflationary because, you know, spending money, always anti-inflationary.
Absolutely. Yeah. She knows what she's talking about. Does that girl?
Yeah. Now, this is on completely different matters. This is China's birth rate. And this dot here is when they got rid of the one-child policy and said you can have 2 children. Well, that didn't work. The birth rates collapsed.
But it's good for the environment, Keith. I mean, birth rates around the world need to drop so that we stop putting so much pressure on the environment.
Yeah, I agree.
And I think the demographic problem of who's going to look after the old people will just have to come out in the wash because, you know, the population of the planet, in my view, is too big to be sustainable. It needs to be smaller. Yeah. And the way to achieve that is with lower birth rates.
I completely agree. Now, a reminder, this is German producer price inflation, which is heading for the stratosphere. Mass 18.4%. Bear in mind,
and the decline in the euro, which has been about a 9% decline since May this year, is going to add to inflationary pressures, just as it is in the UK with the pound against the dollar.
Yeah, absolutely. Well, that's my point, Richard. You know, the euro is declining, which is going to add to inflationary pressure. And at some stage, surely there has to be some pressure from the northern hard currency bloc saying, you know, you've got a 2% target. What's happening?
Oh, so there's a couple of charts from Financial Times about the amount of money available in private equity, and is private equity in a bubble? And what this shows is that there's currently about $400 billion of uncalled capital available for deployment in these big 5 private equity companies, which of course, you know, private equity is seen as something which gives huge returns. I don't think it's necessarily true, although these are very successful businesses, but they can't find anything to invest their money in. And the next chart shows the share prices of these companies, which have gone up remarkably since the COVID crash, 3, 4, 5-fold. And the question is private equity in a bubble?
Yeah.
And the answer is probably it is.
I agree. Well, we have some small shitty angel investments that need a lot of money, and we will sell them for a good price. In fact, we will sell them for a bad price. But, you know,
we should give Blackstone a call after this recording, Keith, see if they're interested.
Yeah, that's a good plan, Richard. I'll leave that one to you.
Thank you, Keith. I'll let you know how I get on.
Okay, on to COVID, and I'm afraid it is bad. Okay, so I've just had a quick look, and it actually Austria is going into full lockdown, it seems.
Have they got a lot of people in hospital, Keith? Is their health system under pressure?
I'm not sure, but the you see, because if you look at this chart, the Austrian caseload is going through the roof. But to your point, Richard, the blue line, the death rate is not following it back up. So I don't know what the hospitalization rates are, but anyway, Austria going into full lockdown.
That is bad news for them.
And if we look at a variety of the countries, so what I thought was interesting is the UK has actually had a very high caseload per million people throughout 2021 compared to other nations.
As you pointed out earlier, Keith, we do a lot more testing.
Yeah.
And the caseload is partly a factor of how much testing you do.
But also, frankly, you want people to have COVID during the summer months, and spread out the caseload.
Yeah, not be ill, get the youngsters immune.
Precisely.
And now,
German caseload is shooting through the roof. The US is actually not doing too bad, but France is rising quickly. So this
I
is.
Read, God, sorry, Keith. I read the other day that if the Delta, there is now a variant of the Delta variant, which apparently is more transmissible but is less symptomatic. And had that variant been the original variant when we were completely unprepared for it, it would have an R number of greater than 5.
Wow. Yeah, but it's not. It doesn't actually cause as much serious illness, does it? So that's correct. Good news.
Yeah.
And the COVID virus is following the usual path for all diseases, and they become more transmissible and less deadly.
Yes.
And this is a closer look at Europe, and not good. It's really rising quickly throughout continental Europe.
And Ireland. I think Ireland is locking down its nightlife, isn't it, as well?
What are you going to do, Richard?
Well, we're not going to Ireland, Keith. I have to stay here in London.
But death rates, really, they're not following the caseload back up. In fact, in the UK, despite the rising number of cases, the death rate is falling. In Sweden, it is rock bottom. But in the US, vaccination rate has fallen behind other nations, and the US caseload is now rising. Now, going back to Sweden, you'd have to say that Sweden has now got herd immunity. So the Swedish caseload is not rising. The blue line is Denmark and Norway, and that's heading back up. So Sweden had all their cases earlier in late 20, early 21, and they now have got no rise in cases, although it did come at the cost of a higher death rate. But all their economic disruption is behind them.
Yeah.
And as a result of the return of lockdowns and COVID disruption, the travel and leisure sectors of the stock market are suffering once again, I'm afraid.
I would say that particularly international business flights, can't ever see them going back to what they were, just because people are much more used to doing video calls. It makes a great deal more sense. And so it aligns with reducing carbon emissions.
Yeah, no, I agree. Be interesting to see, going forward, hotel and travel sectors, which had a large part of their income from the kind of premium business travel sector, will their profits recover to what they were before, particularly with rising input costs?
Yeah, well, only if they put their prices up and are able to maintain reasonable occupancy levels, I guess, Keith, which which is a moot point in both ways. Okay,
so on to equity markets. Richard, do you want to do this?
The FTSE All-Share had a not particularly good week, down 1.2%, 14.6% for the year to date. Stocks Europe 600, slightly better week, and a very good year-to-date number now, 21.3%, almost up with the S&P 500. And speaking of which, had a good week, 1.2% up, NASDAQ up nearly 2%. The TOPIX up just 0.2%, and a similar sort of year-to-date figure for the as the FTSE All-Share. Bitcoin, a dreadful week, as did Ether, down 12.5%. And year-to-date, of course, is good, but if you got into Bitcoin recently, you'd have taken a bit of a tumble with it. And then the GBP US dollar, the pound is continuing to decline. And while it's only down 1.8% year-to-date, I think over the last couple of months, it's down more like 5 or 6%, isn't it, Keith?
Yeah, used to be above 140.
This chart shows that the timing of boards in their share repurchase programs is poor. Well, it's good from their point of view, but it's poor from the investor's point of view, in that they tend to buy the shares at highs and then not at lows, whereas an investor clearly wants shares to be bought at lows and not at highs.
Yeah, so they basically, they only get to make money from their stock options when the share price is a new high. So if the share price is an all-time high and they buy more to send it higher, that works for them, but it's not necessarily what shareholders want.
Oh, so this is a chart of Ether, which has basically done a similar thing to Bitcoin. They had a nasty couple of weeks, although Ether has only just come down and hit its 50-day moving average, which is not an unreasonable move, but still an unpleasant, if you're invested in it, which I am, an unpleasant move. And Bitcoin is in the same boat.
The thing is, Rich, it's broken these lovely tram lines you've drawn in. It's outrageous.
Well, I should have been drawn them lower, shouldn't I, Keith? And it wouldn't look so bad. I know it has. It has indeed, hasn't it? Yeah.
You should write to the technical analysis people and say, doesn't work.
Yeah, the TA team who we have work slaving in the background. They're the ones who get everything wrong, aren't they? And Bitcoin is looking the same. Only worse, it's broken its 50-day moving average and is heading unerringly towards the 100-day moving average.
Okay, on to energy. And oil, having had a very strong run, fell 2.2% this week, although it remains up best part of 70% on the year. But the big mover on the week, I'm afraid, was Dutch natural gas futures. They were up 27%, and we'll go into this in some detail, up 290% on the year. Coal was up 0.7%, uranium up 2.8%. Okay, so having a look at crude oil, this is the crude oil chart. It's come off its recent highs, but is that a floor it's found? Now, commodity producers of all kinds, not just oil, but also materials, have not increased their expenditure yet in line with rising prices. And that's a problem. If we talked last week about copper and how in a couple of years we were going to be short of copper. And really, if we're going to fix that, we need to be investing right now because mines take a long time to bring online. And so far, there's been no increase in investment. So this is all shoring up problems for the future. Talking of which, now this is a very worrying chart. On the left, we have CapEx from the oil and gas industry. And what it shows is that CapEx is well down from levels earlier in 2018, 2019, but is consistent with a net zero scenario for 22 to 30. So they've cut their CapEx. That's fine, as long as clean energy increases its CapEx. Now, the green bar on the right is the CapEx needed by clean energy in order to meet the net zero scenario. And you'll see we are nowhere near it. you need to triple capex. So what this chart shows is that oil and gas capex is low, but we haven't compensated by increasing investment in clean energy. And that is an energy crunch coming your way.
A huge gap. Can I just interject here, Keith? Something interesting. I think I read today about nuclear power in the US, and because electricity prices in the US have been so low, nuclear power has been uncompetitive, and they've been closing down their nuclear power stations. And they close because they've not been profitable, they've been loss making. And they generate about 20% of their power through nuclear electricity in the US. And part of this funding package that has been agreed, 1.8 trillion, is about 600 billion of subsidies to the nuclear power sector. Because clearly what the nuclear power sector, what the price it's getting isn't accounting for is the fact that it is carbon free. Having things have been built, there's a sunk cost in carbon dioxide terms. It's carbon free electricity, and that is not priced into their revenues and should be. And so they're trying to stop these nuclear power stations from shutting down. Yeah, and it just shows what the sort of perverse incentives are in the current energy system, energy market.
Yeah, absolutely. We've talked about this in previous weeklies, Richard, about how when the sun is shining and the wind is blowing, the marginal cost of electricity can be zero and actually can go negative. Yeah. And that destroys the economics of nuclear and baseload. And you need subsidies to keep them online, because actually you need them when the wind doesn't blow. And so the whole energy system becomes more expensive.
And you can't have wind and solar competing with nuclear, because it doesn't work. That's not how it works. They are a combined package that is required. They shouldn't be competing with each other.
Now, going back to crude oil, the EIA is forecasting that actually oil will come down next year and will average $72 a barrel. But I personally remain skeptical in that the EIA's demand forecasts seem low to me. And we've talked previously about how OPEC probably don't have the spare capacity they have. So I obviously have a huge investment in oil and gas companies, and I think that maybe not next year, but over the next few years, oil market is going to be incredibly tight.
I think you're right, Keith. I mean, just have a look at the capital expenditure graphs and the rate at which we are not investing in renewable energy versus the loss of fossil fuels.
Yeah. And actually, when we talk about CapEx, when you try and invest a lot of money in an industry, you drive prices up. And what this shows is the price inflation in oil and gas on the left, solar in the middle, and wind on the right. And you can see that you're getting higher inflation in renewable energy than you are in oil and gas. And that is also going to hit CapEx.
Yeah.
Now, last week, Carios, who use satellite data and actual monitoring, going and visiting sites, see how much oil they've got, they reported a big draw in global inventories of 45.2 million barrels. That's enormous. That's like 6 million barrels a day. And I'm surprised, but investors have actually started in putting money into energy stocks again. So this is Bank of America, and their clients have been big net buyers of energy stocks in the last few years.
There was an article recently, wasn't there, Keith? I think we mentioned it a couple of webcasts ago, where hedge funds have started to invest in the oil sector.
Yeah. I would say that UK oil companies, share prices really haven't moved very much. So, you know.
Yeah, still, the opportunity is still there if you believe in the thesis.
Yeah.
Which I do. And you do, clearly.
Yes. And this, I'm afraid, is Dutch natural gas futures. And we will have an in-depth look at this, because Gazprom are not providing enough gas to refill European storage, and people are now worried that Europe will run out of gas this winter. Okay, so Europe imports about a third of its gas from Russia, about 22% from Norway, and these are the Gazprom storage sites in Europe, and they provide data on how full they are. The bottom line is they're not very full. So the biggest by far is their storage facility in Reden in Germany, and that is 9.4% full. Now the smaller storage facilities are more full, but in total they have a fill rate of only about 24.6%. And if we look at Reden, which is the biggest one, this is the yellow line is their storage capacity throughout 2021 compared to with other years. And you'll see this year is a total anomaly. Normally, they're pretty much full by this time of year. And this year is down at 9.4%. This is in Austria, and their storage facility there generally supplies Central and Eastern Europe, and it's empty. If you look at 2020, this time of year, it was 80% full. In 2019, it was pretty much at full capacity. And this is in Bergermeer in the Netherlands, which is close to the home of the Dutch natural gas TTF future. And there, the storage is only at 30%. And if you run short of gas to fulfill the futures contract will go through the roof. And so on the left here, you see Gazprom's gas flows into Europe. And yes, they have picked up since October, but frankly, they're still below September levels and well down on December last year. You'll see in total, Gazprom's storage facilities are massively down on last year. So the purple line, if you can pick it out, is the forecast for gas storage in Europe. Now, the 10 line here, the bottom line here, is what really matters, because you need a minimum of 10 billion cubic meters of gas stored in the system to provide flow. If you have less than that, you don't have enough gas to push through the system. And so the whole system stops. And Bloomberg is saying that there's a 30% chance that without Nord Stream 2, you'll go below 10, at which point gas prices go stratospheric. And to add to Europe's problems, the carbon price is also rising. So all these massive input price rises for EU manufacturers and households. Okay, moving on to coal. Well, coal's had a big drop, but seems to have stabilized. And I thought this was interesting. This is Chinese electricity consumption, and it is just a straight line. And
the interesting thing about it also, Keith, is it really hasn't, it's not showing any signs of deviating from that 45-degree line, is it?
Yeah. So, you know, they're just going to keep on building coal-fired power stations, I'm afraid. Or they
are building a number of nuclear power stations, but I think they take a lot longer to build than coal-fired, don't they?
Yeah. I mean, nuclear power stations can literally take decades.
Yeah.
Depending on how many corners you cut, of course.
Especially with the rigorous planning regulations they have in China.
Yeah. But that, you know, that is a supporting bid for coal prices and natural gas prices going forward. I saw this from The Economist. So we've just switched on the world's biggest carbon removal plant in Iceland. And it's doing very well because people are paying them for carbon credits and carbon offsets. But let's put this in perspective. Climeworks is aiming to sequester 4,000 tons of CO2 per annum out of 35 billion tons produced by humanity each year. And that is 0.00001%. Much better just not to burn it in the first place. Now, uranium has had a good run and was up slightly on the week. But thank you for Simon W. from our Discord channel for making us aware of this piece of nonsense. So during COP26, Germany, Portugal, Luxembourg, Austria, and Denmark formed a little five-nation party to fight for a nuclear-free Europe. And how many people have died from nuclear accidents? Well, not many. Chernobyl killed about 200 from direct radiation. The UN did an investigation into Fukushima, and they stated that nobody had died directly as a result of the radiation from Fukushima, although lots of people had died from social diseases such as loneliness from being forcibly moved out of the local area. And in terms of deaths caused by disasters from energy systems, the clear winner is hydroelectric, which we all love, because by far the world's biggest disaster was in China in 1975 when the Bangkao hydroelectric dam collapsed during heavy rain, and the subsequent floods killed between 170,000 and 230,000 people. And so, you know, that puts the dangers of nuclear, I think, in some perspective. This is the Bangkao hydroelectric dam. I found reading this article from Forbes very informative. So it ran from left to right. So you can see on the left, that was the lake, and on the right was farmland. And then when the dam broke, it eroded, pushed all this fertile land on the right, and also flooded and killed loads of people downstream. And of course, it was a communist country with their usual concern for the populace. And so they refused to allow anyone to evacuate. Okay, on to the checklist. And, you know, generally another strong week for industrial commodities. Aluminium up 1.2%, cobalt continued to rise up 4.4%, copper down 1.5%, but still within its range, chromium flat at massive highs, iron ore recovering a tiny bit, up 0.6%, lithium carbonate grinding higher, up 1.5%, magnesium bouncing back, up 22%, neodymium flat at highs, nickel down slightly, tin continues its amazing run, up a further 2.3%, ferrovanadium flat to downish. Aluminium has come off but is recovering a bit. Cobalt grinding higher. Copper in its range. Now, copper inventories are low, multi-year lows. So we know that the Chinese property sector, which is a big consumer of copper, is slowing, but the low inventories would seem to suggest that there's still a lot of demand, which is supporting copper prices.
Of course, the renewable energy will create huge demand for copper. Yeah. So there's a trade-off between lost demand from the China property sector and increased demand from the renewable energy sector.
Yeah. Chromium still high, mystifyingly. Iron ore seems to have found a base, but I mean, you're talking at levels lower than the start of the year. It's been a roller coaster ride. Now, in previous weeks, we have talked about the fall in iron ore as being caused by Chinese mandated cuts to steel production. Now, if that were true, you would expect to see very high steel prices because steel production has been cut, and low iron prices, but that's not what's happened. In fact, you're seeing low steel prices as well. And that suggests they're both being caused by a fundamental lack of demand. Now, we know that car manufacturers have really cut their production. They're a big user of steel, but also, Chinese construction has fallen. And so you've got fundamentally less steel demand. Lithium grinding higher, and that is up, what, fourfold on the year. Magnesium bouncing back. Neodymium at highs. Nickel still within trend. Tin, amazing run in tin. And ferrovanadium drifting off or going nowhere. Richard.
Precious metals for the week. So generally, I would have said, I think the last month has been a good month for precious metals, but the last week they've fallen back very slightly. Gold's gone nowhere. Platinum down chunky, and palladium even more. But rhodium has ceased its meteoric drop after its meteoric rise. Platinum group metals year to date have not performed well. So gold is still in its range. Silver is also within its range and has had a perky few weeks. We'll see if it continues that. Platinum actually has had a decent few weeks, but hasn't done well for the year to date. And rhodium has done very poorly year to date. And it's halved since its peak in May.
So finally, on to rates. And we once again had inflation numbers coming out hot in the UK. And are we beginning to see a little bit of reaction from bonds? Because the 5-year UK bond actually fell on the week, but you saw small rises towards the long end. I mean, these are still astonishingly low numbers when you have UK RPI at 6%, CPI at 4.2%, but you can have the privilege of lending to the UK government at 1.1 for 30 years. Now, in continental Europe, rates fell back. So we talked previously about how the Greek 10-year yield was rising. Well, this week it fell back, so that is reassuring. But just to reiterate, the theme for this year is that I'm totally mystified by bonds, because the blue line is US CPI, the white line is US 10-year, and it's just completely failed to react.
I think we just have to acknowledge, Keith, that central banks currently have control over the bond market. Yeah, I genuinely believe that's what it is. And therefore, it has ceased to be the indicator that people used to think it was.
Yeah. So these are US real yields. So the white line is the 10-year minus CPI. And you see, real yields are hugely negative. And these are real yields as measured by tips. So the white line is US 10-year inflation protected. And if you buy those, you are locking in a real loss of over 1% per annum. The blue line is Germany, where if you buy those, you're locking in a loss of over 2% per annum. And we are now heading into a very strong period for global stock markets. Hold on to your hats. Richard, what have you been up to this week?
Thank you, Keith. Well, I had another relatively quiet week, so my portfolio was slightly down. I have to say, I did moderately well on the precious metals mining shares, and moderately badly on my cryptocurrencies, which I include in my portfolio. All in all, I basically went nowhere. I'm slightly disappointed with my change for the year. I just wish I'd put all of my money into the NASDAQ. It would have been so much simpler. Now, viewers will remember that I had the KFA Global Carbon ETF, and I sold it because I thought that with the increase in energy prices, European regulators would say we can't have carbon credits so expensive. We're going to have to do something about this and change the regime. After COP26, I realized I don't think they can do that. And so I bought back into the KFA Global Carbon ETF, which is here. Now I sold it sort of, I think roughly early September. And it didn't do anything, but it certainly didn't drop. And then I sort of missed out on this recent little chunky ride up. Anyway, I'm now back into it and I'm proposing to hold it until it remains to be seen when. So I made the wrong decision there. So this is a graph. People will remember I talked about Graphene Manufacturing Group, and they're making this graphene aluminium battery, and their first product is in collaboration with Bosch. They're building a factory now in Australia to produce button batteries, so rechargeable graphene aluminium batteries, and they have had a superb 8 weeks or so.
Wow.
So I just thought it would be interesting. It's interesting to show that, and I think their market cap must be something like 250 million now. I didn't check. Clearly, there's a lot of interest in this, and obviously, if it were to prove to be an effective way of manufacturing batteries, it's cheap, easy, and it has excellent recharging characteristics and excellent lifetime characteristics, much better than lithium-ion. My view of lithium-ion batteries is that they are a sort of up-to-date, antiquated technology because they're just full of this volatile solvent, and just seems such a clumsy sort of technology to be going forward with. We shall see, but this is a little bit of a punt of mine. And then I've been keeping an eye on junior silver miners via the Junior Silver Miners ETF. And what's noticeable is it has broken out of its downtrend. It broke out of its downtrend in sort of early to mid-October, and it is now above all its 20, 50, 100-day moving averages, which I think is quite a good sign. So I think silver miners is something to keep an eye on.
Because we like silver because of its exposure to solar. So a lot of solar panels, you need silver in it.
Yeah, exactly so. Keith, how about you? How was your week?
Thank you, Richard. I had an okay week, entirely due, I have to say, to Rambler Metals. I was up 0.75%, which takes me to 11% on the year, and underperforming the all share, but kind of catching up with Richard and Stuart. And
not that it's a race, Keith.
Oh, it is, Richard. It's absolutely a race. And I know that Richard had an amazing year last year. He made a best part of 70%, wasn't it? And I had a very good year last year where I made 35%. So frankly, I'm very pleased with 11%. And I know that if I'd stuck it in the NASDAQ, I would have got a much better return. But, you know, I really think the NASDAQ is overvalued and I would not be happy putting my money there. So I'm very happy where I am. Now, I continued to sell a little bit of Anglo-Pacific because I wanted to buy more Atalaya Mining, which we did a share talk on, which I hope you have all watched because I think the shares are good value, and its exposure to copper, which is a green metal, and there's a lot of essentially state-backed structural investment into green energy, and that will be a support for copper demand. And I'm currently working on a share talk on Gulf Marine Services. Now, frankly, I know a lot of our viewership is like me. They were after, ideally, a small, high-risk potential multi-bagger, and this is one. It's essentially rents out self-elevating support vessels, which are these boats which have four corners at which there is a pile that you can lower, and you lower the four piles and lift the whole boat out of the sea where it becomes a rig, a support vessel. And it's basically back in 2016, it took on a load of debt to expand the fleet just when the oil market downturned, and it's been a total catastrophe for shareholders. But there's new management and they seem to have got some of the debt issues sorted. So it's a turnaround play and we will see. Watch this space. Okay, so this is Rambler. Rambler had a fantastic run and obviously overshot and the share price come back. But, you know, we remain very bullish medium term. And I've gone from being deeply underwater to actually decently profitable on that trade, but remain very bullish. And they produced some drilling results this week, all of which were very good. This is Diversified Energy, and regular viewers will know that Diversified Energy has a problem with methane leaks, but they've come out with a statement saying that they are going to expand the team that is hunting for methane leaks and increase the number of wells that they seal shut every year. All of that is good news, and the shares are very cheap.
I noticed, Keith, I mean, they're on a dividend yield of about 11%, and they go ex-div on the 25th of November. So people should, if anyone holds that, they should just bear in mind that on the 25th of November, there might be a significant percentage drop as they go ex-div. I'm not quite sure whether it's what size the dividend is. Yeah.
I think it's 2.9 cents from memory.
So about 2.5%.
Yeah. Now, Atalaya Mining, which I bought this week, you know, bear in mind, this sharp drop here was the 7% dividend. So if you take that out, it's continued to grind higher. This is Gulf Marine Services. Now, Gulf Marine Services, this chart starts off back in 2016 above 50p. So this is not a good story. But yeah, I bought a load at the rights issue at 3p. And it kicks off a lot of EBITDA earnings. Sadly, all of EBITDA gets consumed by bank service charges on its enormous debts. So it's highly geared to an upturn in the oil sector. Now, a stock we have not covered, but has been caught my eye, is Rio Tinto, because share price has come off by a third in the last 3 or 4 months. It's now on a forward dividend yield, which according to Yahoo was 11%. I have to go and dig into this, see whether that's true. But that's starting to get interesting. I have put in a bid at £40, sorry. And, you know, very exposed to iron ore. And if the iron ore price turns back up, it should do well.
Is that why it's dropped, do you think, because of the exposure to iron ore?
Well, I think all the commodity companies have come off. So there's a bit of euphoria crept in earlier in the year and it's come off. But yeah, it makes a lot of money from iron, and iron's, you know, collapsed. So, okay. Thank you for sticking with it to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.